Friday evening. We have Mr. Amit Grover with us, who will be helping us with today's topic, which is on rebalancing. So, as you'd already be aware, Ab India Karega Invest is an initiative we've been holding since the past around a year, a little more than a year. And it was offline. We used to go to different cities and meet different investors live in person. But thanks to the pandemic, we are here online. But this is also nice because we can call a lot more guests and very quickly, and we can meet more people because across the country people join us. So today's topic is rebalancing, which is, in my opinion, a topic that people don't really discuss much about. So we have a lot of talks and webinars and shows on where you should invest and which categories and subcategories of mutual funds are the right ones. But it's somewhat like, we get started, but then nobody tells you what to do after you've started. So rebalancing is an eternal part of your investments. Once you've started, for the rest of your life that you're investing, you should be rebalancing across different assets. So this is, I feel, an extremely crucial step that not many talk about. And thankfully, we have Mr. Amit here today, and he'll be talking to us about this topic. So, Mr. Amit, over to you.
Thank you, Shekhar. Thank you, Groww. Let me share my screen. Okay, so today's topic is very interesting. We'll talk about strategies to rebalance your investment portfolios. Before I move into it, let me start with a very, very basic thing. Personal finance is more personal and less of finance. Money is a very emotional subject, and that's why you have to understand the emotions which go around money. I have seen people earning money, but the problem is if you ask people in a very personal way, what is the purpose why you're earning money? For what goals are you saving this money? For what goals are you investing? Most likely, people don't have a clear goal in terms of why are they saving and investing their money. So the first thing in any personal finance is that write down your goals. Be very clear in terms of why are you saving and investing this money. Write down your short-term goals, write down your medium-term goals, write down your long-term goals. Generally, people save for buying a house, buying a car, their higher education, the children's higher education, maintaining the standard of living, vacation, children's marriage, and most importantly, retirement. Unfortunately, the most important thing, retirement, which should be the first priority, people always keep it last. So if I have to give a very simple advice, keep retirement as your first goal. And why I'm saying retirement should be your first goal, because unfortunately in this country, nobody will take care of you. You have to save for yourself, and most likely will get retired at the age of 50, 55. We'll live very long. We'll have a 25 to 30 years of long retirement. And that's why retirement has to be your first goal, along with other goals. So first step is define your goals. Once you have defined your goals, then you have to also keep in mind something which is an invisible enemy, which unfortunately people are not able to think about it because it's invisible, and that's called as inflation. And what is inflation? If I have to give you a very simple example, I'm sure everybody has seen an iconic movie called as Diwar. 1975, this movie got released. The cost of a movie ticket was 3 rupees. Okay. And if we all know, if in case today we have to go to a multiplex, a cost of a movie ticket is around 300 rupees. That in simple terms is called as inflation. 3 rupees in 45 years becoming 300 rupees, which is 100 times, that's inflation. So the most important thing, as an investor, you have to also understand that you have to keep inflation in mind while saving and investing your money. Once you have done that, now it's all about figuring it out, which asset classes to use to achieve this goal. I'll predominantly talk about 3 asset classes. First is equity, second is debt or fixed income, and third is a little bit I'll discuss also about gold, and I'll tell how a combination of all 3 will help you achieve your goal. These 3 asset classes and the combination is called as asset allocation. And why we call them asset allocation is because in these 3 asset classes, something unique happens. When equity is performing, maybe debt and gold is not doing that great. When gold is doing very well, maybe equity and debt are not doing very well. And when debt is doing exceedingly well, Maybe equity and gold is not doing well. The beauty is it's like a cricket match. You have a combination of all three. Either of them would always be doing well. So let's start with understanding equity. Unfortunately, I've seen people think that looking at the markets on a daily basis is called as equity. No, that's not called as equity. Let me explain equity in a very simple terms to you. Equity means investing into businesses. And what are these businesses? Honestly, all these businesses are in front of me. When I look at the wall, I can see Asian Paints, Nerolac, I can see Cement Company, ACC, Ultratech. When I look at the fan, I can see Havells or Anchor. Or when I look at my slippers, I can see Bata or Relaxo. When I go for shopping, I can see DMart or Shoppers Stop. When I take a two-wheeler, I can see Hero or a Bajaj. I take a car, I can see Maruti. When I fall sick, I can see Cipla, Sun Pharma, Ipca Laboratories, Lupin. When I go to DMart, I can see all the FMCG goods. Right from getting up in the morning, when I brush my teeth, I can see Colgate or a Pepsodent. Or when I use Atta, I can see Ashirwad, ITC. Or when I have Maggie, I can see Nestle. The bottom line is all these companies are basically in front of us. Right from going to a bank like a HDFC, ICICI, Axis, or a SBI to buying mutual funds towards the insurance, these are all listed companies. What is equity investment? Equity investments, in simple terms, means investing into businesses from a long-term perspective, which helps you create wealth. And it's so simple. When you invest into an HDFC Bank or HDFC Limited, somebody else is doing the work for you. You are a mere shareholder and you create wealth just because you are a part owner in that company. The problem is people forget this definition of equity time and again because they get carried away with something called as emotions in the market. Let me explain you the risk and reward of equity first. First of all, when we talk about equity, the journey of equity is not a straight line. Sensex, which is nothing but the top 30 companies of the country, okay, it started somewhere around 3rd April 1989. It's almost been 41 years. If you would have invested in Sensex 41 years back, 1 lakh rupee, the value today would have been approximately 4.9 crores. 1 lakh in 41 years, 4.9 crores. That's the power of equity. But unfortunately, the journey was not a straight line. The journey had ups, it had downs, it had good time, it had boring time, it had horrible time. And all this is part of the equity journey. Let me show you with data points what is the risk and reward what equity has to offer. Let me first show you the journey of equity market in the last 21 years or 20 years. If you were an equity investor, 2000 to 2003, 3 years, you made no returns in equity market. It's a very boring period, disappointing period. Most likely you will lose patience. 2003 to 2007, for 4 years, equity gave amazing returns. 2008, unfortunately, we had a global financial crisis because of which markets corrected more than 54%. But then things recovered back. There was a bounce back in the market. But unfortunately, from 2008 to 2014, for 6 years, equity market gave no returns. Imagine 6 years of boring returns. And then 2014 to almost 2020, it was the markets were doing exceedingly well. Then unfortunately, again in March 2020, in 21 trading days, we saw markets correcting by 36%. Then again, after the correction, market bounced back, and now they are doing exceedingly well. And as we speak right now, markets have almost touched 49,000 level. The entire 20 years journey, if you look at the CAGR of Nifty, is approximately 13%. Nifty is nothing but the top 50 companies of the country. This is how typically the journey of equity market looks like. It's not a straight line. Boring times, good times, horrible times, boring times, good times. And this is how the journey is. And one has to be prepared for this journey when he's a long-term investor. It's not a straight line. In fact, this journey is exactly a journey of a businessman. If you talk to a businessman, he'll say, you have boring times, good times, bad times, horrible times, and amazing times. It's not a straight line. So please understand your horizon of equity should not be 1 year, 2 year, 5 year. It should be decades, 1 decade, 2 decade, 3 decade. That's how you create wealth. That's the first point. And understand the journey. Now, let me tell a second point about how this returns look like. Okay. This is the annual returns of equity market. And unfortunately, when we say that equity market gives you around 12-13% return, okay, over a longer period of time, it doesn't mean 12-13% every year. Some years you get amazing returns. Some years you get normal returns. And there are few years where even you get negative returns. And then there are few years like 2008 where you have bad returns. understand that's how the journey of equity market looks like. Now, I'll just explain something about risk, okay? And this is a very important slide for me if you have to understand equity, okay? This slide explains you by what percentage does market corrects every year, okay? Let's take an example of 2020, okay? If I ask you what was the returns in 2020, you would say overall 2020 was a good year. We made around 15, 16, 17% in Nifty. It was a good year. That's fine. The calendar year gave around 17% return. But if I ask you, what was the fall which you experienced in 2020? That means from the highest point to the lowest point, which is the biggest fall which you experienced, the fall was 36%. Remember, Sensex was at 42,000 level. It went to 26. So we saw a 36% fall. The interesting point is, if you look at history, you will realize that market corrects every year. Right from 1990 till 2000, I'm showing the data. The data point shows that market corrects every year. There is not even a single year where market doesn't correct. That means market correction is like Mumbai's rainfall, that it happens every year. Yes, some year it happens more, some year it happens less, but it rains every year. And that's why one thing which you have to be very sure about equity market will always be volatile. And honestly, if you want a view of equity market for the next 5 years, 10 years, 15 years, 20 years, my simple answer is markets will be volatile every year. So please be prepared about volatility in equity market every year and don't get bothered about it. Once you've understood the returns of equity and also once you have understood the risk of equity, I'm very sure that you have understood typically how equity as an asset class works. I have to just talk about one point. Sometimes we get too carried away with success stories, okay? Success stories of Bajaj Finance or maybe HDFC Bank or Eicher Motors. And we always feel, oh God, I wish even I had that stock in my portfolio and I would have made 100% return or a 10 times return. Never forget, mutual funds is the most important thing when it comes to equity mutual funds. Why mutual funds? Two things. First of all, there's a fund manager who is managing your money. Okay, there's an expert who is doing it. So you have outsourced it. And second thing is he's diversifying your money. The money gets diversified across various stocks. There are basically across various securities, your money gets diversified. Across many sectors, the money got diversified. Why I'm talking about diversification? Remember Nokia. Nokia was like the Apple phone of today. Everybody had a Nokia phone. But today, honestly, nobody even remembers Nokia. Nobody has a Nokia phone. Remember BlackBerry? Everybody had a BlackBerry phone after that. But today, nobody has a BlackBerry phone. Why diversification? Because you don't know which companies will do well or survive. When you diversify, your risk comes down. Use mutual funds and also diversify your money through mutual funds. That's an important message which I want to give you when investing into equities. Second point, now I want to explain you how typically asset allocation looks like. Let's imagine you saw the equity journey and you realize the returns are amazing, but it's also very highly volatile. What do I do with that? So let's imagine I have built up a portfolio of 50% equity and 50% debt. It's a combination. It's a mixture. It's a mocktail of equity and fixed income. When I do a mocktail of it, fixed income gave approximately 6.5, 6.7% return. Equity gave approximately 13.9% return. When I make a cocktail out of this, a mixture of both of them with 50% equity and 50% debt, the combination returns is 11.2%. But look at the yellow line. Look at the volatility. The volatility is so low. So you get good returns also with very less volatility. And that's what I mean by asset allocation. Mix two asset classes. One which can create wealth but risky. Second, which is fixed income, which is safe, but also gives moderate return. When you have a combination of it, it gives you moderate return with moderate risk. This is what I mean by asset allocation. Now, let me explain the third asset class, which ideally you should not have too much in your portfolio, but somewhere around 5 to 15% maximum, between 5 to 15%. Gold is something which you can have in your portfolio. First of all, Indians love gold, and people think that gold is an Indian asset class which gets mined in India. Unfortunately, that's not the case. Gold is actually an international asset class. Why I say international? Because first of all, the mining of gold doesn't happen in India. It happens across the world, mainly in Europe, a little bit in Australia and Latin American countries. This is where basically the gold gets mined. Okay, so it is basically mined abroad. Second, the value of gold happens in dollars, which also happens abroad. technically we think it's Indian. There is nothing much Indian about gold, but it makes sense to have around 5 to 15% of gold in the portfolio. And why one should have? Let me give you an answer for that. In fact, if you look at the world economies, okay, whether you look at US, Germany, Italy, France, Russia, China, Switzerland, Japan, India, if you look at the government in terms of what are they holding, all the biggest countries in the world, all the great 20 countries in the world, all of them are holding gold, okay, as part of their sovereign wealth funds, okay. They all are holding gold. So ideally, the gold is a store of money. During times of uncertainty, gold does very well. Having some amount of gold in your portfolio makes sense. The unique thing about gold is, first of all, scarcity. You cannot produce gold. It's not like money where you can print money. The amount of gold in the entire world and universe is quite limited. We have approximately 190,000 tons of gold. That's the only available gold which is there in the world. Second is, gold is durable. And what do I mean by that? If you take gold and if you bury it, even after you come after 50,000 years, that gold will still be there. The properties would not be lost. And third is, gold is malleable. You can make fine sheets out of gold, fine wires out of gold. And that's the reason why it gets easily used as ornaments and other things. So this is a property why gold is precious to people. Having 5 to 15% of gold in the portfolio makes sense. How it features into asset allocation, let me show you with data points. This is a very interesting chart. And when you look at the chart with detail, you will realize that when equity is not doing well, gold does very well. And when gold is not doing well, equity does very well. I will highlight the point, especially from 2008 to 2014. 2008 to 2014, this 6 years, equity market didn't give good returns. In fact, there were flat returns in equity market. But during this time, 2008 to 2014, gold gave amazing returns in India. In fact, very good returns in India. 2014 to 2019, equity market gave very good returns in India. Unfortunately, gold was almost flat for 5-6 years. Look at the beauty. When gold is not doing well, equity performs and vice versa. Having a combination of both is an amazing asset allocation. So what is asset allocation in simple terms, if you ask me? It is a combination of having equity in your portfolio, equity mutual funds in your portfolio, debt mutual funds in your portfolio, and little bit, which is 5 to 15% of gold in your portfolio, which you can buy in the form of maybe gold mutual funds. So gold mutual funds, equity mutual funds, and debt, maybe like a short-term fund in your portfolio. A combination of this is basically, in simple terms, is called as asset allocation. And how much to put in this various asset class? That's my second point. Now, this is a very interesting point in terms of how much should you put in terms of equity, fixed income, and gold. And to answer this, I'll come back to the same question. First of all, define your goals. For what purpose are you saving it? Once you have defined your goals, your short-term, medium-term, and your long-term goals, you know how much risk you can take to achieve these goals. Second is, look at your own behavior. How sensitive you are to a loss. And what do I mean by how sensitive? See, we all humans, we might look alike, but the point is, emotionally, we all are different. Okay. And let me give you a very interesting story about it. There was a person called as Mr. Harry Markowitz. He got a Nobel Prize. He made a very complicated formula in terms of what should be the right asset allocation, for which he got a Nobel Prize. But when he was asked, sir, what is your asset allocation? Do you also use the same formula when building your portfolio? He said something very interesting. He says, I don't use that formula. My logic is very simple. I have 50% in equity and 50% in fixed income. And then somebody asked him, what is the logic of 50-50? He says, my logic is very simple. When equity market is doing very well, I thank God that I've got equity in my portfolio. And when fixed income is doing very well, when markets are correcting, okay, I thank God that I've got fixed income in my portfolio because there is too much volatility. And he says something very interesting after that. He says, with having a 50-50 portfolio, I can sleep very well. A very important point. With this portfolio, I can sleep very well. That's the same advice I would like to give it to you. Build a portfolio in such a way that you're not worried whether the markets will correct tomorrow or it will not correct about. So you have sufficient equity to create wealth. At the same time, you have sufficient fixed income to absorb the volatility. It's a cushion to absorb volatility. And you also add a little bit of gold in your portfolio to manage uncertainty. A combination of it is very unique to every client. There is no fixed formula. It's very unique to every individual because everybody's goals are very different. Everybody's psychology is very, very different. Everybody's life situations are very, very different. So first of all, understand your situation and make a plan which is absolutely in sync by what you are and what your goals are. That's the first point. Now the question is, how do you rebalance your portfolio? Okay, so let's imagine there is an investor. I'll give you my example. Okay, I'll give you my asset allocation because it will serve as an example to help you in terms of how do I look at things. So I'm around 40 years old, and my goals are something like this. I've got a son who's 8.5 years old. So I've got two primary goals. First, I'm saving and investing for my retirement. I plan to get retired at the age of 55, so I'll have 30 years of retirement, and I'm saving and investing for my son's higher education. Two primary long-term goals. I've got short-term goals where I have to go for an annual vacation. That's my short-term goal. And I have to buy a new car after 5 years. So that's a medium-term goal. And I also keep a decent amount of money for emergency because life is uncertain. Something about emergency. My asset allocation is 60% equity, 30% debt, and 10% gold. That's my asset allocation based on my risk appetite, based on my goals and the way how I look at things. How do you rebalance your portfolio? First thing, if circumstances in life change, and what do I mean by that? Let's say if I get a bonus, if I get a salary hike, or maybe I change my job and my salary becomes double. Yes, then what happens? Maybe I can take more risk because my income is more high. But for some reason, let's say I have to leave my job, or maybe if my wife stops working, or if there is some health problem in the family, or maybe there's something, God forbid, something else happen. My circumstances changes. So if your circumstances are changing, you have to rebalance your portfolio. Your portfolio has to be rebalanced first based on the changes in circumstances which happen in your family. Or maybe I am planning a second child in my family. Circumstances changes, my asset allocation changes. The first thing why you have to rebalance your portfolio is based on circumstances changes in your life. So plan A you have thought, but for some reason plan A is not working, circumstances changing. Plan B, if plan B is also not working, plan C. So you have to change and adjust your allocation. Second thing, why you have to rebalance your portfolio is because the changes in value of portfolio. So I'll give you a simple example. In March 2020, when markets corrected, since the markets corrected by 36%, my equity allocation became less. My debt became high because markets corrected. So during that time, I invested a little more money in equity because my equity allocation was low. My debt was high because market value had come down. Today, as markets have increased by almost 70, 80, 90% from those levels, my equity allocation has become high. My fixed income allocation has become low only because equity value has gone up. So I won't use the word profit booking because that's not a right word. That's used for traders. What I've done is, again, I've rebalanced my portfolio. I'll explain this with a simple chart over here. Let's say you started with 50% equity and debt. As markets moved up, your equity value has become more. So you rebalance it so that again it becomes 50-50. So again, what I've done is I've slightly removed my money from equity because I have to again rebalance my portfolio with 60% equity, 30% debt, and 10% gold. Because with this allocation, my logic is simple. I can sleep very well. And that's what I mean by rebalancing your portfolio on a strategic basis. Second rebalancing which happens, which is a tactical rebalancing, it happens on valuations of the market. There are times when equity markets are very expensive, and there are times when equity markets are very cheap. And then there are times when equity market is fairly valued. Obviously, when markets are very expensive, and then ideally it makes sense to reduce your equity allocation. And when markets are dirt cheap, it makes sense to increase your equity allocation. And how do I do that? So to explain this, I will be slightly technical over here. Please bear with me. There is a ratio called as price to book ratio. And what do you mean by book? Let me take a simple example to explain this. Let's imagine there's a manufacturing firm. If I have to liquidate that manufacturing firm, if I have to sell that manufacturing firm, suppose I get 100 crores, okay? And obviously I have taken some loan from the banks, which is 20 crores. So 100 crores I get because I've liquidated the firm, sold the firm, and 20 crores I give it to the banks because I've borrowed money from them. I get 80 crores. So 80 crores is the book value of the firm. Market is pricing this company at maybe, let's say, approximately 160, okay, 160 crores. So what is price to book value? 160 crores divided by 80. So price to book is 2 because the market value of that company is 160 The book value of that company is 80 crores. So what happens? 160 by 80 is equal to 2. Now what happens, and how does price to book of Nifty helps me figure out whether markets are cheap, expensive, or fairly valued? I look at historic value of Nifty's price to book. The maximum highest price to book ratio was in 2008, which was 6.4. The minimum price to book ratio of Nifty was around 3.5, and we saw it twice. First was in 2008 when markets corrected, and also in March 2020 when markets corrected, when we saw the lows of price to book 3.4. So the maximum is 6.4, minimum is 3.5 based on 20 years evidence. The average of price to book is around 3.5. The average price to book is 3.5. Where are we trading right now as we speak? We're trading at 3.96. So we are slightly above averages. If the average of last 20 years price to book is 3.5, we are 3.96. So tactically, maybe if in case somebody wants, they can be slightly underweight equity, but honestly, it's still fine because 3.96 and 3.5, they're still decently close. I would call markets, as per my view, as per my understanding, I feel markets are fairly valued. So tactically, neither I'm underweight equity nor I'm overweight equity. I'm sticking to asset allocation as per my risk appetite. So I'll just revise in terms of what all we have discussed. Okay, we have discussed around 8 big points. First of all, it starts with defining your goals. And when I say defining your goals, be very clear about it. Take a paper, take a pen, and write down your goal. And no visual thinking. I want to travel across the world. That's not a goal. Write down precisely. I want to go to Singapore after 2 years. This is the cost. So be very particular about your goal. Okay. Second thing is have a combination of equity to generate wealth. And what do you mean by generating wealth? That means equity has the only potential to beat inflation. That's why it's called as wealth creator. So have equity in your portfolio, equity mutual funds preferably. Have fixed income in your portfolio, preferably short-term funds. This is what I'll recommend. And have some amount of gold in your portfolio. Preferably, I would say no ornaments, please. Only gold mutual funds. Okay, that's what I'll recommend. Equity, debt, and gold not more than 5 to 15%. Always have an emergency fund. What do you mean by emergency fund? Put that money in an ultra short term or a liquid fund. Why I'm recommending this? Because uncertainty is something which will never tell you in advance that they are coming. Okay, like COVID, a pandemic, uncertainty can come anytime. So always be prepared for that. Have an emergency fund. Always remember that equity was volatile, is volatile, and always will be volatile. So don't get carried away with the volatility and the uncertainty. Never forget about fixed income because it helps you provide cushion in your portfolio. And lastly, rebalance your portfolio based on circumstances changes in life. Also rebalance your portfolio if one asset class has either moved up or fallen down. Rebalance it as per your risk appetite, okay, based on the changes of asset price. And lastly, always follow process. Don't get carried away with emotions. Money is a very emotional subject. It's very human to get carried away with emotions in the market. So I would again say, document what you are doing, stick to a plan, stick to a process, and I'm very sure all of you will be able to rebalance your portfolio and achieve your financial goals in a logical fashion. With this, I'll end the session and I give it to Shikhar. Shikhar, you can take it from here. Thank you.
Thank you so much. I'll just very quickly share my screen. 1 second. Right. I hope the screen is visible. Yes. Right. So what as I mean, thanks, Mr. Amit, for talking to us at great length on this very important topic that we usually don't end up discussing in investing webinars and talks. Anyway, so now I will be walking you through the product that Groww is, what we offer, what all features we have, and so on. And after this, we will take questions from you And our usual attempt is that we try and answer every question that you post. So please leave your question if you have any question, doubts about investing, about rebalancing, about anything with regards to investing, and also with regards to Groww. And we'll try and answer every single one of those questions. Now, coming to my screen, let me first tell you that tell you how Groww was actually what was the main driving reason for starting Groww. So, as you'd know, in India, investing is it's very limited in style. People invest in a certain way. Most people invest in a certain way and don't invest in certain ways, which means most people don't invest in stocks and mutual funds, whereas most people invest in FDs and gold and real estate, right? So one of the main reasons why Grover started was this, that being able to invest in all kinds of investments should be easily available to all of us, to most of us in the country who have a smartphone or a laptop, right? So let's get back to my screen. When you open the app for the first time, this is what the screen will look like. It's very easy to sign up. You can use it. You can sign up using a laptop or a smartphone. If you have not done your KYC before, we'll get it done for you for free. And all of this is 100% paperless. There's no paperwork involved. It's all done via your smartphone or laptop. Now, when you open the app, this is the first screen you'll see. You'll see this is what we call the explore page. So on top, you'll see a search bar where you can search for mutual funds and stocks. Below that, you'll see 3 tabs. There's stocks, there's mutual funds, and there's gold. So when you tap on mutual funds, you will end up on the explore page of mutual funds. Likewise, if you press stocks, you'll end up on the stocks explore screen. And if you press gold, you'll end up on the gold explore screen. So these explore screens are where you get started in that investment option, be it mutual funds, stocks, or gold, right? Now, if you end up searching for and clicking on a mutual fund, you will end up on the mutual fund page, which looks like this. You have the mutual fund, you have its all possible details about that mutual fund. They'll be mentioned here. They could be, returns, their pros and cons, expense ratio, holdings, fund manager, uh, their performance when compared to similar funds, all of those details, all that you should know about a mutual fund, you'll find those details on this page. And likewise, if you search for a stock, you'll end up on the stocks page, which again would have all the possible details of a stock that you could possibly want to know, be it different ratios, the reports, 52-week high, low, all of those things, right? Similarly, when you open a gold page, this is what you'll see. You'll see the details of the digital gold offering. Right now on gold, we have one digital gold offering, which is via Augment Digital Gold. So you'll see that. But as we add options in the future, you'll be able to see other gold pages also. One common misconception our investors, rather not our investors, every mutual fund investor in India seems to have, is that you can only do SIP in a mutual fund, that you have to make a monthly investment. It has to be repeating. That's not true. You can do SIP every month, or you can also do one-time investment where you invest once and not again, just like you would with, let's say, an FD, right? And there's another misconception. Once you start, and many people think once you start a SIP in a mutual fund, you can't do one time. Or once you start a one-time investment, you can't do SIP. There is no such limitation. You can invest in one mutual fund as many times as you want. You can have 2 SIPs in the same mutual fund, 3, 4, as many as you want. And you can have one-time investment in a mutual fund in which you have an SIP, and the vice versa also. So it's extremely flexible. This is the dashboard screen. Dashboard refers to your investments. So again, at the top, you'll see there are 3 tabs. There's stocks, mutual funds, and gold. And when, again, as you'd expect, if you tap mutual funds, you will be able to see all your mutual fund investments. Likewise, if you tap stocks, you'll be able to see your stocks investments, and gold will be your gold investments. So in this screen, you can see the mutual fund dashboard, where you can see the names of the mutual funds that you would have invested in. If you tap on any mutual fund, you will go to the more detailed section of that investment. So in that page, you'll be able to see things like your average NAV, your folio number, all your transactions in that mutual fund. Like, for example, which dates you redeemed, which dates you invested, very similar to a passbook. So this is what that screen looks like. You can see in this case, there's only invested, invested, and invested. But had you redeemed or withdrawn money, that would also have shown up here. And right at the bottom of this page, you'll have these two options, which is invest more, if you want to invest more in that mutual fund, and sell, which is if you want to take out your mutual money from that mutual fund. You can invest on Groww using all sorts of payment options like UPI, there's net banking, there's NEFT, RTGS, IMPS. All of those options are available to you on Groww. Now, coming to this very, very popular feature on Groww, which is import and switch. So what is import? Now, let's say you have investments that are in that you made via some other option, via some other platform or other person, and you would want all your investments now in one place so that it's easier to track. All your mutual funds are in one place together, consolidated, right? So if you want to do that on Groww, you can import all your mutual funds to Groww. To do this, just go to your dashboard, mutual fund dashboard, scroll all the way down. At the bottom, you'll be able to see this option called import, and just follow instructions. Again, it's very easy, very paperless, very smooth. It doesn't take much time. Now, once you have imported mutual funds, chances are that if you were investing on some other platform, they were regular mutual funds, which means you were paying a commission for them. If you want to switch them to direct plan where you don't pay any commission, you can do that using the switch option. So again, first you will have to import, and once you can see these imported funds on your dashboard, you will also be able to see the switch option. So using that, you can easily switch your regular plan mutual funds to direct plan mutual funds. If you have any questions, please feel free to reach out to us, email us at support@groww.in, and we try and make sure that you have an absolutely fantastic experience. If you have any doubts with regards to the product, you can also use the help and support section. We try and answer almost every question there. And you can also raise a ticket from the help and support section and contact us over call, chat, and email. Please follow us on Facebook, Twitter, LinkedIn, and YouTube. If you're a new investor, you might find the YouTube channel very resourceful. We try and upload content that is of high value to new learners. So please do go and check that out. A couple of other things. We are one of the highest rated mutual fund apps, or rather investment apps in India. Practically all mutual funds, we have them. Over 1 crore users, SEBI and AMFI registered. Our security system is bank grade. We use 256-bit encryption, and we are an ISO certified company. With that, I come to the end of my presentation. Now we will start taking questions. Mr. Amit has joined us back. So first question for you. Okay, so the first question to you is, considering the high valuation multiples, is it a good time to book some profits and grandfather the long-term capital gains?
Sure. Okay. First of all, again, I'll repeat what I had discussed in my presentation. Just rewind back 40 years back. Okay. In fact, 1980 is the same time when I was born. If my father would have invested 1 lakh rupee at that time, the value today would have been 4.9 crores. In the 40 years or 41 year journey, I'm sure thousands of times, lakhs of times, this would have been discussed that markets are touching all-time high. because when 100 becomes 105, it is all-time high. 105 becomes 130, it's all-time high. Becoming 200, it's all-time high. 250, it's all-time high. 400, it's all-time high. Even 1,000, 2,000, 3,000, 10,000, 15,000, every time markets will touch all-time high. Today we are touching 49,000 and 50,000. Sometime in the future, it will also become 1 lakh. We'll again say it's all-time high. Just basis of how markets are moving up, don't define whether it's all-time high or it's not all-time high. Okay, look at valuations. So I look at and I respect 3 valuation matrices, and I'll just give you a definition of all 3: price to earning, price to book, which I've just discussed, and market cap to GDP. I explained price to book. The valuation of price to book as of now is slightly above fair valuation or the average valuation based on history. So if you look at price to book valuation, markets don't look expensive. In fact, they look fairly valued. But now let's look at price to earning ratio. Today, as we speak, Nifty is around 40 price to earning. Sensex is around 34 price to earning. This seems expensive, okay, based on price to earning when you compare it with historical price to earning. But you have to dig down deep. Why is that price to earning which is expensive right now? What is making Nifty price to earning look expensive? The common sense is like this. What is price to earning? Price upon earning. Look at earnings. Because of COVID, because of pandemic, the earnings have almost come down by 20%. So in fact, pre-COVID, whatever earnings we had, we are down 20%. Since your denominator has come down, your price to earning multiple looks high. Second point which you have to understand, the last 10 years for corporate India has been the pathetic corporate earnings. The last 10 years earnings, unfortunately, were around only 3 to 4%. Okay. Economies work in cycles. There are some part of the decades or the cycle with earnings are very high. And for some reason, the earnings in some cycles are very low. So we are actually in the last 7, 8, 10 years, our earnings were very low. So we are at the bottom of the earnings cycle. Hopefully, in the next 5 years, 7 years, 10 years, the earnings should recover. And this is what markets are discounting. Markets are always forward looking. They are discounting the future forward earnings which are going to happen. Okay. Market is always forward looking. Second point. Third is the indicator which I talked to you about, market cap to GDP. If you look at market cap to GDP, it's around 80, 85 level, which is below or very close to our historical average. So that indicator shows that markets are not expensive. They're slightly above fair valuation. Also, one thing which you have to also understand, we are living in a world with practically free money available, amazing amount of liquidity and very low interest rate. Practically 1/3 of the global debt is trading at negative interest rates. There is ample amount of money which has got printed. Even if you look at RBI, the repo rate and the reverse repo rate are at historical low levels. So low interest rate, ample amount of liquidity, a possible vaccine, and strong earnings in the future. Market is always forward looking and it's discounting it. I won't say markets are expensive. Neither I would say markets are cheap. I would say market are fairly valued or slightly above fairly valued. So I don't think any reason for you to worry about the markets. But that doesn't mean that markets will not correct or markets can't correct. I showed you the chart. Volatility and uncertainty is part of the game. If you are a long-term investor and you're investing into equity with a horizon of 7-year, 10-year plus, you don't have to worry about equity market.
Right. So the next question is right after this question. The next question is, what is market correction and why is a correction always negative?
Okay. See, there are 2 ways of looking at correction. Okay. Some people look at it in a very positive way. Some people look at it in a negative way. I would like to put this question like this. When you fail, do you feel happy or do you feel sad? Honestly, if you are smart, you will say, I should feel happy because you learn from your mistakes. You have learned a message. Okay. You should feel happy about it. But do we feel happy about when we fail? No. So actually, if we understand that market volatility is the nature of equity market. See, understand, equity market is nothing but who are the buyers and sellers? We are people, and human beings have emotions. Sometimes there are emotions of fear. Sometimes there is an emotion of regret. Sometimes there's an emotion of greed. And there is sometimes the emotion of sadness which is there in the market. And because of these emotions, markets are always volatile. When market corrects, people call it correction. You can An optimist can also say it's a buying opportunity, because when market corrects, the same good companies like Bajaj Finance or Reliance or HDFC or ICICI or Aisha Motors or all the good companies which I know and I like, it's a good opportunity for you to enter. So you can call it correction and you can feel bad about it, or you can say it opportunity. Or I would just say stick to your plan, stick to your asset allocation, let market do what they have to do. You have to be a logical investor, do goal-based planning, stick to your asset allocation, and try to be as cool and calm as possible.
Right. Next question is physical gold or digital gold?
See, physical gold, see, historically, people, in fact, my parents, and if you look at our previous generation, used to buy gold predominantly in physical form. And it was fine because at that time, there were no avenues for financially buying gold in digital way. But there are a lot of problems with physical. First of all, there are making charges. There are transaction charges. There is a cost of theft. There's a cost of storage. There's a possibility of a lot of impurities also in the gold. And there's also a big problem that from wherever you have bought, from which jeweler you have bought, you can only sell it to that person. So there's a lot of challenges with gold. And most importantly, today with 10 grams of gold being 50,000, if somebody wears an ornament, you cannot go outside because you're carrying so much wealth and there's a possibility of theft. Okay. So I think physical is not the best thing. I would think personally buying gold in a digital form, maybe like a gold mutual fund or a sovereign gold fund, or maybe the digital form, if in case you can buy gold, that's the best way of doing it. Personally, I buy gold in sovereign gold fund, and I also do an SIP in a gold fund. That's how I do it. But I would rather prefer financially buying gold in a financial way. But yes, if in case you want to buy a little bit of physical gold just to keep yourself happy, you can maybe buy some gold coins or gold bars. That's it. But ornaments, personally, I'm not a fan for that.
Okay. Okay. The next question is, the RBI governor told that India's real economy is not matching the financial markets. Would be great if you could tell me some perspective. Give me some perspective. Okay.
See, RBI. See, if you made wealth by learning economics, then all the economic professors would have been very rich. Honestly, the RBI governors, Raghuram Rajan, they would have been very rich. Okay. What they're not wrong. They are perfectly right. They are saying that what they're giving is the commentary of the current market. Okay, when I say market, means the current economy, that the current GDP is low. Currently, the businesses are having challenges. Currently, interest rates are low because businesses have yet to come on track. Vaccine, how the vaccine plays out and what is the efficacy of that, only time will tell. So what the RBI governor typically talks about the economy is the current state of the economy. I'll again repeat what markets are. Markets are forward-looking. Markets don't behave in terms of what is happening to the economy right now. They are discounting on what will happen to the economy 1 year, 2 year, 3 year down the line. There are forward-looking machines. That's why markets are going up, because market works on anticipation. Market doesn't work on current commentary. So yes, the RBI governor is right about the economy. Markets are also right because markets are forward-looking.
Okay, thanks. So the next question is, what is your view on tactical asset allocation based on PE?
PE in isolation can be very misleading. If it was that simple, then ideally the whole finance books, all CFAs, PhDs would have got over there, and one mantra should have been given. High PE means markets are expensive, low PE means market is cheap. PE in isolation can be very deceiving. I just gave you an example, like PE is nothing but price upon earnings. If your earnings for some reason falls down, the price to earning multiple might look very high. Okay, so you look at price to earning, look at market cap to GDP, look at price to book, and also look at interest rates in the economy. And based on that, you can build a view whether to be tactically overweight equity or underweight equity. I'll again repeat that. But you know what? There is a, like, to be tactically overweight or underweight, you will take a tactical risk. I'll give you an example. I know certain clients who were tactically underweight equity in the last 7 months because they thought markets were expensive for some reason of theirs. Last 7 months, markets have rallied and they have missed the opportunity because they were tactically underweight. So being tactical underweight comes with this tactical risk. Okay, what is the risk? That you took a view, and if the call didn't go right, you lose that opportunity. So there are two ways of building a portfolio. One is strategic, where you build a portfolio as per your risk appetite, and you say markets are efficient and I'll not do anything. And the second is tactical, where you believe that if in case markets are slightly expensive or cheap, I might be increasing or decreasing equity by a small percentage. Tactical doesn't mean zero equity or 100% equity. It just means, like, for example, I'm 60% equity. At times when markets are cheap, tactically I can be 70% equity. Or when markets are expensive, tactically I can be 40% equity. I make a band out of it. It's not like 0 versus 100. It's being slightly overweight or underweight based on market scenarios. It depends upon your risk appetite. If you think you know the rules of the game and you can do it, be slightly underweight or overweight. But don't make it like enter into equity and redeem out of equity. That's a wrong process. We are in the business of personal finance. Stick to asset allocation, stick to planning.
Right. Okay. Next question is, how should you position or rebalance your investment during market correction?
You're right. So, for example, I'll give you a simple example how I did in March 2020. I had an allocation of 60, 30, and 10. When markets corrected, so obviously my equity allocation became less. I switched some amount of money from debt to equity so as to make a right combination. And now, again, as markets have moved up, my equity allocation has become very high because the value of equity has gone up. Again, I've slightly rebalanced my portfolio so that my allocation remains aligned to what I'm most comfortable with, which is 60% equity, 30% debt, and 10% gold. I'm not saying this is an ideal asset allocation for everyone. It suits me as per my risk appetite, as per my goals. I don't know you. I don't know your goals. I don't know your risk appetite. I don't know why are you saving money for. So please make your asset allocation based on your goals and your risk appetite.
Okay. So the next question is for me. How do I invest in international markets and markets through Groww? Right. So this is a question okay, I have an easy answer which I can tell you, which is US stock market investments is possible via Groww.in, the website, not the app yet. So go to the website, create an account, and you'll be able to invest in US stocks. But you have to, this is another side that not many people know about in mutual funds, which is if you're interested in certain countries that you want to invest, let's say US or emerging economies or China or something like that, there are mutual funds that invest solely in the market of a certain country. You have China specific funds, you have US specific funds, you have funds that invest only in the emerging countries and economies of the world. So please explore that if you're looking for international exposure for your portfolio. Don't just explore only stocks investing using some platform, be it Groww or others. There are many other options. Please make sure you explore mutual funds also. Okay, great. So now we'll move to the next question, which is, after a certain event that happened earlier this year, this particular user is afraid of debt funds, and they're asking what checks should they put in place so that they can be more at peace about their debt fund investments.
Sure. See, in debt funds, try to understand there are two risks in a debt fund. One is the interest rate risk and second is the credit risk. I'll explain both of them in just short time. What is credit risk? Let's imagine that you have got two friends. One friend is working in a very good company, amazing job. He's always been very particular about paying the money. Okay. And the second friend, unfortunately, he's not working in the best of companies and he's always lazy in terms of making his payments. Both of them are borrowing 1 lakh rupees from you. So the first friend, he's saying, I'll give you 8%. The second friend is saying that I'll give you 12%. Where will you give your money? It's like deciding. In the first friend, maybe the returns are low, but you know he's completely trustworthy. I'll 100% get my money back. In the second friend, you're getting high returns, but there is some amount of risk over here because there's a possibility he might not give you money, or there's a possibility of default over here. The second friend is nothing but called as credit fund. What is credit fund? You are taking a credit risk. You are investing into those companies which are slightly low rated, but you get higher returns over there. And the same in the first case, it's a high quality fund. It's a AAA. It's a rating of a company. The highest quality companies are called as AAA. So if in case you are conservative and you want moderate and you're happy with moderate returns, invest, look at the portfolio, whether it's a AAA oriented portfolio. Are the names known and the rating of the paper are AAA? That means you are taking practically very low credit risk because they are the best quality papers in the country. Examples of AAA are like HDFC, ICICI, NABARD, PFC, good PSU companies, government companies, and good banks over here. Okay, these are called AAA. So first, if in case you're conservative, invest into high quality AAA funds. Second is interest rate risk. Any bond which is of longer tenure, based on changes of interest rate, the fluctuation is very high. If you're a conservative investor, rather be into a good ultra short-term fund, a medium-term fund, or a banking and a PSU fund. Be in this category of fund because it will have low interest rate or moderate interest rate risk, and it will have, and look at the portfolio. It should be around a AAA oriented quality portfolio. So you're reducing the interest rate risk also, and you're reducing the credit risk also. But you'll also get moderate returns with this. So that's how you manage your portfolio. You have to be cognizant about the risk. You can't just take returns for granted and just get carried away with returns. You have to look at the risk before investing.
Okay, thanks. Next question is for me. Actually, next two questions are for me, and then we have, okay. So first question is, in case I redeem my fund, will the next SIP installment be deducted? Yes. So this is a misconception many people have, which is if I redeem or take out money from my SIP mutual fund, that the next SIP installment will not take place. It will take place. If you want the SIP installment to not take place, please go and cancel SIP. SIP and your investments are two different things. SIP is basically a mechanism, a method via which money gets put in your mutual fund, and the investment is the money that is in the mutual fund, right? So if you cancel the SIP, then no future installments will take place. If you want to keep your money and just want to not pay for the future SIPs, cancel the SIP, you don't need to redeem, right? But if you redeem, don't expect the SIP to automatically get cancelled. They are two separate things. Cancel SIP is different, redeem SIP is different, okay? Great. So the next question again for me is, how can I get tax certificate of ELSS which I purchased through Groww? Okay, so tax, we give a report for tax, for the tax requirement. You can find this in the report section. So on the app, at the bottom, go to the U tab, which will be on the rightmost side, and there you'll find a section called reports. Tap on that and there you'll find it. And on the website, go and tap on your profile pic, and then go and click on your name, not anything below that, on your name itself. And then on the left side, you'll be able to see a reports tab where all of these reports will be completely visible to you. You can download the report from there. Okay. Next question, and which is also the last question of the day. Gold ETF versus gold MF versus gold SGB. What would you go?
Buy all three. It's fine.
Okay, and in what quantity? Like, are you saying buy all each of some quantity?
Or? I'll give you the benefit of all three. Gold sovereign bond has the best benefit because the returns in gold are tax free. So basically, whatever returns you get in gold, the government gives you the exact same returns. Over and above that, the government also gives you 2% extra interest rate every year, but that interest is taxable. But the returns of gold are tax free. So gold sovereign bond is the best thing. You get gold returns plus extra 2%, and the gold returns are tax free. But the disadvantage of that is the money gets locked in for 7 to 8 years. So the disadvantage is lock in, less liquidity. Gold ETF, the advantage is that amazing amount of liquidity. You can buy today, you can sell it tomorrow, but the returns are taxable. It has debt taxation. Gold mutual funds are also equally good. You can do an SIP in a gold mutual fund. So even that has got sufficient liquidity. You can buy and sell it whenever you want. So you can use a combination of both. All three you can have. The advantage of sovereign bond is that you'll get better returns, but unfortunately you'll get less liquidity. So that's a trade-off. So if in case you're comfortable with the 8 years lock-in, then go for gold sovereign bond. But if you want a combination of both, then take a combination. But if you want liquidity at any given point of time, then don't buy gold sovereign bond.
Okay, thank you so much for that. Thank you for joining us, Mr. Amit. It was lovely having you here. And thank you everyone for coming to this session. Again, next week we'll have another Ab India Karega Invest session, and we'll have another guest. And hopefully very soon we'll have Mr. Amit back with us for another session someday very soon.
Sure.
So thank you. Thank you, everyone.
Thank you, everyone. Have a good time. Thank you. Happy investing.